This year, something remarkable happened in finance. Ontario and Alberta, two of Canada's largest provinces, issued multi-billion-dollar bonds. But for the first time in years, major U.S. banks were left out. This wasn't business as usual. It was a clear signal that the cozy relationship between Canadian governments and Wall Street was shifting. In June 2025, Ontario issued a $2 billion 10-year US dollar bond. Normally, American banking giants would be at the center of such a deal. This time they weren't even invited. Instead, British bank Barclays and Canadian banks BMO, CIBC and Scotiabank took the lead. Alberta did the same in March, raising €4 billion in Europe. Again, no US banks involved. These weren't oversights. They were deliberate choices, and they caught the financial world off guard. The message: the rules of North American finance are being rewritten, and Canada is leading the change. These decisions stemmed from growing frustrations and were a direct response to ongoing economic disputes with the US. The financial world is deeply connected to politics and trade, and this move made that clear. By excluding US banks, Canada flexed its financial muscle and signaled that privileged access to Canadian business could no longer be taken for granted. The comfortable status quo was over. This was a new chapter in a long and complicated story, one that would have ripple effects far beyond the bond market. The exclusion sent a shockwave through the financial community. It was a wake-up call for Wall Street and a bold assertion of Canadian independence. The world was watching and the implications were clear. Canada was ready to chart its own course. The era of automatic US dominance in Canadian finance had ended. The question now: what comes next? The financial world braced for more surprises. The game had changed, and everyone would have to adapt. The story was just beginning. Why did Ontario and Alberta make such a dramatic move? The answer lies in rising tensions between the US and Canada. Years of trade disputes, tariffs on steel, aluminum, and agricultural goods, created uncertainty and friction. The US imposed tariffs. Canada retaliated. Supply chains were disrupted, trust eroded. What began as economic policy soon felt personal, straining a partnership that had lasted for generations. For Canada, these tariffs were an attack on economic sovereignty. Factories in Ontario that once relied on seamless cross-border trade now faced new costs and risks. The financial decisions by Ontario and Alberta were a direct spillover from this trade conflict. By excluding US banks, Canada sent a message. The pain of the trade war would be felt on Wall Street, not just in factories and farms. Finance became a new front in the dispute. Canada realized it could use its power as a major borrower to get the attention of powerful US players. This was a shift from quiet diplomacy to bold action. The old integrated financial relationship was now on the negotiating table. Canadian officials decided a stronger message was needed. The world of high finance had become a new battleground. The consequences would be felt on both sides of the border. The financial integration once seen as untouchable was now in question. The trade war had officially gone global. As US banks were sidelined, new players rushed in. European and Asian financial institutions saw opportunity where Wall Street lost ground. London and Frankfurt banks quickly strengthened ties with Canadian provinces, managing complex bond deals and related financial activities. Canadian pension funds shifted focus, building relationships with European regulators and investors. The search for new partners didn't stop in Europe. Canada began cultivating economic relationships in Asia and South America, building new export chains and financial infrastructure. Vietnamese brokers started arranging freight insurance for Canadian shipments, no US bank guarantees needed. This was a deliberate effort to diversify away from American dependence. Canadian leaders recognized the risks of relying on a single partner. By building ties with Europe and Asia, Canada created a more resilient economic future. These new relationships brought fresh opportunities and perspectives. The US would remain a major partner, but Canada was now building a global network of allies. No matter how North American politics shifted, Canada wouldn't be left isolated. The financial landscape was changing fast. Canada was hedging its bets and winning new friends. The world was watching as Canada rewrote the rules. The exclusion of US banks sent shockwaves through Bay Street, Canada's financial heart. For decades, Toronto and New York were deeply intertwined. Suddenly, that certainty was gone. The move was more than a political statement. It hinted at a long-term pivot away from the US traders, and investors spoke of a financial Cold War. Risk managers scrambled to adjust strategies, now tracking European central bank rates alongside the US Fed. The cost of doing business in Canada rose, higher guarantee fees, shorter bond maturities, and a new risk premium. But there were winners too. Canadian banks like BMO and CIBC gained prestige and profits. Nimble investors found new opportunities in the shifting landscape. Government finance teams had to adapt, building relationships in London, Frankfurt, and Tokyo. Issuing a bond was now a geopolitical act, not just a financial one. The comfortable world of North American finance was gone. In its place, a fragmented, uncertain environment demanding new skills and global thinking. Bay Street was forced to rethink its future. The old playbook no longer applied. The stakes had never been higher. The new nationalistic stance wasn't limited to finance. In April 2025, Ontario introduced a Buy Canadian policy for public contracts. Canadian suppliers now had first priority. Allied countries like those in Europe and Asia came next. US firms were last in line. This shift changed the game for thousands of businesses. American companies that once relied on Canadian contracts suddenly found themselves at a disadvantage. The policy boosted domestic investment and gave Canadian firms a protected market. Critics worried about higher costs, but the message was clear. Access to Canada's public sector was now a privilege, not a right. The ripple effects were immediate. Jobs, investments, and supply chains all felt the impact. Canada was doubling down on economic self-reliance. The rules had changed and the world was taking notice. These high-level decisions had real-world consequences. Canadian pension fund managers, responsible for millions of retirees' savings, now had to diversify globally, no longer relying on the US market. They built new networks in Europe and Asia, hedging against prolonged trade tensions. The retirement security of millions depended on their global savvy. Small businesses felt the impact too. A solar panel assembler in Ontario gained market share thanks to tariffs, but still faced uncertainty from global supply chain disruptions. Plans to expand into the US were reconsidered. Building in Canada now made more sense. Every decision, from factory locations to hiring, was shaped by the new geopolitical reality. The changing relationship between Canada and the US was felt in boardrooms and on shop floors alike. The stakes were personal, not just political. Canada's economic future was being rewritten, one decision at a time. The world was watching. The policy changes left a mark on financial flows. The Canadian dollar weakened, then stabilized as Canada built new partnerships. Access to US dollars became tighter and more expensive, especially after business hours. Liquidity dried up in ways not seen since the late 1990s. Capital flows between the two countries became more cautious and short-term. US asset managers hedged against a prolonged trade war, adding cost and complexity. Canadian companies looked to Europe and Asia for capital. The once smooth tide of cross-border investment was now choppy and uncertain. The financial relationship was being fundamentally reshaped. The world was watching as old patterns broke down. The future was up for grabs. Despite the drama, the US and Canadian economies remain deeply intertwined. Decades of free trade have created shared industries and vast cross-border investments. Severing these ties would be costly for both sides. US investments in Canada total nearly $500 billion. Canadian holdings in the US are even larger. This interdependence acts as a brake on any complete split. Excluding US banks from a few deals is a protest, not a divorce. The fundamental connections remain, but trust has been eroded. Even small increases in risk have real costs. Higher borrowing, shorter investment horizons, more contingency planning. The integration will likely survive, but it may be more fragmented and transactional. The cracks are starting to show. Is this a temporary spat or a permanent break? The answer depends on what happens next. If trade disputes are resolved, old patterns may return. But something fundamental may have changed. Canada now has new options, global partners, new procurement rules, and a more resilient economy. Businesses and pension funds may not want to go back. The future may be less integrated, more diversified, and more complex. The past year was a wake-up call. Even the closest partnerships can be strained. North American finance will never be as predictable again. The consequences of these bold moves will echo for years to come.